The United States national debt held by the public has just crossed 100% of GDP, the first time since the aftermath of World War II. As of the end of March 2026, publicly held debt stood at $31.27 trillion against the trailing 12-month GDP of $31.22 trillion. For investors and policymakers, this isn't an immediate crisis. America isn't Greece or Argentina. The dollar's reserve currency status, deep treasury market, and mostly domestic ownership have kept borrowing costs low even as debt climbed. Japan, with debt exceeding 250% of GDP, has run this playbook for years without default. Post-World War II, US debt peaked at 106% before growth and inflation steadily brought it down. The real issue is the trajectory. Under current law, the Congressional Budget Office projects debt held by the public rising to 108% of GDP by 2030 and 120% by 2036, surpassing the World War II record. Structural deficits are running near 6% of GDP, driven by aging demographics, healthcare costs, and the interest itself. Net interest payments already consume a record 3.3% of GDP in 2026 and are headed for 4.6% by 2036, roughly $1 in 5 of federal revenue. That crowding out effect is what matters for markets. Higher debt tends to push long-term interest rates up, siphoning capital from private investment and slowing productivity growth. A mere 0.1 percentage point rise in rates adds hundreds of billions to deficits over a decade. Fiscal space for the next recession or geopolitical shock shrinks. Future generations inherit slower income growth and tougher choices on taxes or spending. Entitlement reform, revenue measure, or spending restraint will be required to stabilize the path. Political gridlock has delayed that reckoning. The 100% threshold is a reminder that delay has costs. Treasuries remain the world's safest asset in the near term, but vigilance is warranted. Expect upward pressure on yields if markets price in fiscal dominance. Equities and growth assets could face headwinds from higher rates and lower potential GDP growth. Crossing 100% is symbolic. The failure to bend the curve isn't. America's fiscal credibility has bought time. Using it wisely, that is before the interest crowds out everything else, is what will matter the most.